Feroz Aziz, who's the Deputy CEO of Anand Rathi Private Wealth. Good morning, Feroz. Great to have you on the show. Let me first get in your thoughts on where the markets are headed, given the fact that we've seen the markets regain momentum after the correction that we had seen. In fact, mid-cap, there's a party going on out there. We've seen the mid-cap index, hitting record highs day after day. Do you think mid-caps are the place to be at the current juncture vis-a-vis the large caps?
Good morning, Nandita. I think, like you rightly pointed out, the mid-cap index has done very well. The small-cap index has outperformed the mid-cap index as well. So the broader markets are getting this momentum because of the domestic flows. We've seen about 25,000 crores of inflows from the domestic institutions and about 12,000 crores of inflows in the month of August from FIIs. So the inflows, when they come from the domestic side, of course, the broader market runs. And if the inflows are from the FIIs, overweighing the domestic inflows, then Nifty outperforms. Now coming to the more important forward-looking question of what kind of outperformance is possible in these two indices relative to Nifty, to my mind, the answer is there is still a lot of steam left in these two indices to outperform over the next couple of months. But I think as the general election takes the center stage, we will have some degree of shift to Nifty because there will be some degree of risk aversion, which will result in some underperformance, not in this calendar year or the last part of the calendar year. You can see underperformance of the mid-cap and small-cap because of the risk aversion and flight of capital, which will definitely be there before the general election and the uncertainty it brings in. But we have seen the last 5 general elections, 1 year, 6 months before and 6 months later. If you invested, those are opportunities rather than adversities, and people should capitalize on it. Being more stock specific is what is going to be the name of the game for small cap and mid cap because of valuations of some of the counters being astronomically high and not sustainable.
Right. Pockets that one should look at, when it comes to stock specific action. Would you say defense, manufacturing takes precedence over consumption now?
I would say I would still vote for consumer cyclicals because of the kind of per capita income increase which we've seen, and the share of wallet in terms of expenditure is going to go up. The rural demand is currently a little lackluster, but that's expected to go up. So if you make money when you're a little ahead of the curve. So consumer cyclicals outperformance is what we've been calling out for the last couple of months, and that seems to have played out. And I think that will play out for the next 6-8 months. So consumer cyclicals will be my vote. IT sector is definitely another sector which had bottomed out a month and a half back, and that's where we called out IT sector's reversal. And with some of the reports claiming that in 2024 you will have a $5 trillion expenditure, $5.1 trillion expenditure globally on IT with AI, and also taking the center stage of that sector. You will have a lot of expenditure there. And of course, Europe has slowed down from discretionary expenditure perspective on the IT side, but that will certainly be behind us. So IT will be one sector, and consumer cyclicals will be the other sector, which we think has the potential to outperform Nifty by about 5-6% over the next 1 year.
Right. We have, of course, seen a good resurgence in the IT sector gaining traction over the last few sessions. But let's also talk about somebody who's looking to, accumulate wealth with a time horizon of somewhere around 10 years or thereabouts. What should be the asset allocation strategy be like right now, Feroz? Equities are running up. Interest rates are here to stay higher for longer. So how much of an exposure should one have to debt funds going forward? What should the right asset allocation strategy should be at the current juncture?
It's Nandita, in my opinion, when you speak of longer periods, before we get to the asset allocation, I'd like to spend about 30-40 seconds on what are the variables which will determine your returns on different asset classes over 10-year periods. In the short term, news is going to be overwhelming, and that's going to dictate the direction of the market. And in the medium term, corporate earnings take the driver's seat. But in the long term, economy really influences what the asset returns are going to be. So I'm going to touch upon about 3-4 variables which seem very good from an economy standpoint, and that's when my asset allocation suggestion will be substantiated. If you look at the GDP growth of 7.8%, contribution from the service sector was about 10.3% growth, 6.2% growth for this financial year seems very likely, with 7.8 being clocked in the first quarter. That's point one. So GDP, a tick mark. If you look at GST collections, I've seen 11.4% increase for the first 5 months, which I think is healthy. Of course, there has been a little downtick for the last month. But I think overall, you're looking at 11.4% growth. So GST collection is a great economic data of the actual activity. That's a tick mark. If you look at the inflation, of course, has come up significantly. from the 4.87 to 7.4. That's driven by the vegetable prices, and I think it'll cool off. That will not require another rate hike, which is a very important variable for the next 1-2 years. Fiscal deficit, we have only penetrated into our expenditure of 33.4% over the first 4 months. So we've not spent flamboyantly. We've been very fiscally prudent. If you look at the weighted average for the last several years, and in fact, long-term averages, 58% of the expenditure is done in the first 4 months. And this year, we are just 33%, which will mean that the borrowing in the government is going to be low, which will put some pressure on the downward side on the interest rates. That's on the fiscal deficit side. That's a tick mark. If you look at flows, that's a tick mark, which I already read out to you. Given all these variables, as long as the economy is progressing in the direction which IMF has predicted for us to be the third largest, if that were to happen, I would not say that 10 years monies need to have debt at all. A 70, 80, 90% could be equities as long as you're able to withstand the shocks of 14, 15% correction every financial year. So asset allocation for 10 years, to sum it up, I would say 80% in equity, about 15 odd percent in debt, not in conventional debt, because taxation is out of the window from a debt fund standpoint because of the Section 50AA inclusion. You should look at arbitrage funds for the next 2-3 years, can give you that post-tax 7% return because of the elevated interest rates. So that's the allocation. Of course, you can have, you had Manisha on the show. And she would be very upset if I don't give any allocation to gold. And she has always called out gold very beautifully. I'd say 5-7% in gold and sovereign gold bonds is something could be the allocation from a 10-year standpoint, with a standard deviation will not exceed about 11-12% if you have this kind of a composition.
All right, crucial to keep gold in your portfolio. But last question to you, Feroze. We have, in fact, we are seeing a lot of new entrants in the mutual fund space with, Jio Financial, BlackRock, you have Zerodha, AMC, Helios. So, exciting times ahead for the mutual fund space. How do you expect this landscape to change going forward?
It's the biggest and the best news possible in the mutual fund industry, because we had privatization of the mutual fund industry in 1993-94. And that really transformed the landscape. And today we are sitting at about 4 trillion rupees as our assets under management. But this is the digitization of the mutual fund industry. And if that were to happen, and if we are able to bring in 5-10 crore fresh investors, all asset management companies will benefit from it, because no new investor only invests in one AMCs. All AMCs coexist with 10-15% market share. So if Jio Financials has the power using the Aladdin platform of BlackRock to go to the nooks and corners of India, which is Bharat largely, you will have 5-7 crores addition. So whatever new investors you've added over the last couple of decades can be added in the next 3-4 years. And if somebody comes into the mutual fund spree and becomes an investor for 30-40 years, he's not going to restrict himself or herself to the AMC which brought him in. He's going to buy the largest AMC, which is SBI. He's going to buy the second largest AMC, which is HDFC. He will buy ICICI funds as well. So the biggest, this is another paradigm shift. If you look back 10 years from now, you will see this is the digitization of the asset management industry, which is the need of the hour if you have to penetrate the Indian investing landscape, which is abysmal today. We are just about 16% of our assets under management as a percentage of GDP. US is at 1.4 times their GDP as AMC size. And global average is 84%. So we are still scratching the surface, and digitization will actually bring in the fillip to get to what we deserved.
All right, exciting times lying ahead for the mutual fund space. With that, Feroze, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. It was a pleasure speaking to you.
Likewise.